Welcome to Retire Well TV. My name is Cynthia DeFazio, joined today by Pete Samanuk of Citizen Advisory Group. To our viewers at home, do you understand what an RMD is, a required minimum distribution? Well, why is it so critical to understand what it is, and not only that, but to get it right? There are different strategies for collecting your RMDs, and we're going to talk about that today with Pete one-on-one. Pete, how are you today?
Doing great, doing really good. So one of the best parts about this show, you never know who you're going to get. Right? We mix it up, we keep it interesting. So just me and you today.
It's just me and you,
yes,
and it's going to be a great show. I'm always excited to be with you in the studio, so thank you again for having me.
I don't know why, too. This is weird. I love this topic. It's why I chose to write this show. It's a weird, nerdy financial advisor thing, but I love this topic.
Well, I love this topic, too, because a lot of people don't understand what an RMD is. So right off the bat, what exactly is an RMD, Pete? What are we talking about?
Yeah, and that's why I love this topic, is because it is so misunderstood, and there's just a lot of misconceptions about it. So what we're talking about today is what's affectionately called the RMD or the RBD, or your required minimum distributions, right? That's the amount that you are forced to take out of your pre-tax investment accounts, right? Your IRAs, your 401ks, your 403bs, your TSAs, your 401as, all these. We don't even know what type.
Soup,
we don't even know what types of accounts we have to take them on. Okay, but that's the amount that the IRS forces you to take out on an annual basis and start to pay the taxes on.
Okay, all right. And so why is it so critical that people understand what they are exactly and the different ways to collect them, if you will?
Yeah, so the name of the show today is RMDs, Don't Try This at Home. And it's critical to understand what required minimum distributions are, is because it's something that you are required to do every year. That's why it's called a required minimum distribution. And so you are required to do something, and no one knows really what that something is. So they're requiring you to take money out. And if you don't do it, there's a big penalty for that, right? So there's a big time penalty if you miss doing this. And most people are thinking, oh my gosh, do I fall into that boat? Am I supposed to be taking that? And so, the parameters around this, and I don't know if we're at this point in the show, Cynthia, if we're going to segue into this. But yeah, let's talk about, who actually has to take a required minimum distribution.
What age? Because I know that's changed, Pete.
Correct.
You're the expert, so please share some information about that.
Yeah, so that's another part about when we say don't try this at home. It's gotten more confusing over the years. It's actually gotten more confusing to us as advisors. Now, we have a pretty good grasp on it, okay? But I'll admit, I run into situations. We're in a situation right now with required minimum distributions at work. I kid you not, we have gotten 6 different conflicting answers because there's so much complexity to this case. This individual's still working, and we're rolling money out from a plan and rolling it to a traditional IRA, and he's going to continue working next year, and he's 75 or 76. And we have gotten 5 different answers on does he need to take a required minimum distribution.
Wow.
Okay, so that's how confusing it can get. So in its general form, okay, clients or individuals, you are required to take money out of your pre-tax assets at the age of 73. Okay, the current age is 73. Now, I get different people all the time saying, I have to start taking that money out at 70, right? Or I have to take that money out at 72. That used to be the law, right? So we used to have to take things out at 70 and a half, and then it moved up to 72. And then with Secure Act 2.0, that's actually been moved all the way until 73 at this point. Okay, so it's very confusing to know where you fall in that. And now to add another caveat into that, and I won't talk about inherited IRAs quite yet, but clients that were born 1960 and later, okay, if you were born January 1st, 1960 or after, your required minimum distribution age is now 75. Okay, so you're actually being phased up to 75, and most people don't understand that. I think a lot of advisors actually don't realize that's part of the law at this point.
Well, especially when it was like the half. It's like, how do you even know what your half birthday is? I mean, how do you figure that out? And you don't get a reminder that says, hi, dear Joe Smith, it's time to take your RMD. I mean, we don't get that in the mail. So
yeah, and that's the biggest point. It's actually making me think of 2 things as a parent and a father at home.
Yeah.
Is that half birthdays are weird, right? People ask me, how old is my daughter? And I'm like, 3.5. So I'm not 39 and a half or something like that. But the 70 and a half makes it confusing. And then the other thing that's making me think about, when you have your first child and you're like, okay, when are they supposed to start school? There's like not an instruction manual to this stuff. I'm like, am I supposed to contact the school? Is she supposed to be starting school?
Yeah, like how do we
I'm
know?
just counting on my wife to kind of figure all that out and let me know when we're supposed to do it. Okay, but it's the same. It's funny you said that because it's the same thing with required
Yeah.
minimum distributions. It's like you might not even know you're supposed to do it. Like for the IRS does not call you and tell you, hey,
Exactly.
Joe, you're 73. You have to start taking required minimum distributions. You, as the taxpayer, you can read this tax code pretty much in any layer of the tax code. It's this thick and 500,000 pages.
Yep.
Any layer of the tax code, pretty much at the end of everything, says the responsibility is on the taxpayer. Okay, it's not going to be on the custodian of the funds. It's not going to be on the financial advisor. It's not going to be on the company that you work for. It's up to the taxpayer to take their required minimum distributions,
Yes.
right? So they have all the legal liability, and if you don't do it, that's when we're talking big penalties.
Absolutely. And that, they'll let you know. Like, hey, you missed it. Here's your penalty, right?
Exactly. Yeah. It's the same thing as like, when
Yes.
we're talking about filing for Social Security and things like that. They'll let you know when you've made a mistake. So when you don't take your required minimum distribution, and I'll segue into that right now, is that, again, you have to take it by, well, we'll talk about some of the pitfalls and some of the different ways we have to take it. But let's be clear about something. If you don't take your required minimum distribution, okay, let's say that the IRS said, look, you have this many dollars in a pre-tax asset, and you were required to take $50,000 out in this calendar year by the end of 2025, and you didn't take $50,000 out, guess what the penalty is? Do you know what it is, Cynthia?
I know that it used to be 50%,
Yeah.
but did that not
Yeah,
change?
so it came down a little bit.
Okay.
50% was very severe because
Yeah.
why? Well, they wanted to make sure you were going to do it. Now it's come down. It's 25% at this point, and that's another thing people don't realize. That penalty has come down from 50% down to 25%, but that's still a pretty severe penalty.
Oh,
Okay, let's think about
absolutely.
that, right? So let's think about you didn't take $50,000 out like you were supposed to and pay the taxes on it. That's not an extra tax. They're going to penalize you an additional $12,500 on top of that
Wow.
$50,000. And that's penalty money. That's
Oh
not
my
money you're getting back.
gosh.
That is not money that they're going to say, oh, well, we'll put that back in your account later. That's just a penalty to the IRS that you're required to take.
Oh
and
my
as we get
gosh.
bigger, let's say it's $100,000 you're required to take. And we do run into numbers like that time to time. We have a required minimum distribution right now. It's large. I forget what it is. It's in the, I have to think about this. It's probably it's a big number. It's millions
Okay.
of dollars, okay?
Wow.
And so if you don't take that required minimum distribution, you might have $1 million penalty. You might have $100,000 penalty just by failing to do something that they didn't tell you had to do.
That is so crazy. I mean, Pete, I know we're going to take a commercial break, but I want to talk to you about how is the RMD calculated when we come back from the commercial break. But most importantly, you have an offer to the viewers at home today. Talk a little bit about what that is before we open up the phones.
Yeah,
in the
certainly.
commercial.
So what we're offering for any callers or clients that want to come in and schedule a complimentary consultation is our written financial plan. And as part of that written financial plan, we're going to talk about really the 5 main areas of financial planning: your investment planning, your tax planning, your risk planning, your estate planning, and then your retirement and cash flow planning. And really require minimum distributions. They fit right into the investment planning, the tax planning. And if you don't have a plan for your taxes and your investments and your cash flows, that's going to be part of the required minimum distribution planning. That's when you're going to find gaps. You're going to miss it if you don't have these written pieces. So that's what we're offering for clients today, is that complimentary written financial plan.
Pete, thank you so much. To our viewers at home, once again, that number to call is 866-630-1675. You need to get it right. There's so much to understand, and the rules keep changing. You need a guide. This is not something that you want to do at home. And how do you have a guide? Well, you call in 866-630-1675, or even simpler still, grab your smartphone, click on the QR code at the bottom corner of your screen. Takes you right to the landing page of Citizen Advisory Group. It puts you on the fast track, if you will, so that you can schedule your time accordingly. When it comes to required minimum distributions, you deserve to get it right. We'll be right back after this very short commercial break.
So I started in the financial services industry 15 years ago, and I'd love to give you some awesome story about how I just woke up when I was 6 years old and said, I'm going to be a financial advisor. But the truth is that I kind of fell into it. I think so many of us, like after I graduated college, I was 22, 23, and trying to figure out what all of this looks like. But it took me probably 2 to 3 months to realize that this is the career for me. I love financial planning. I love helping individuals. I love meeting different people and families and their circumstances. I really want to get to know you as an individual. And I just think that's way more important than kind of diving into how much money you have, is what you're trying to do. I have been in financial services and financial planning for 15 years. I've actually been with Citizen Advisory Group for all of those 15 years. So a lot of my clients that I work specifically with, I've known for 15 plus years. And it's just super enjoyable and very gratifying to be able to know people, know their families, know their pets by their first name, know their kids by their first name, watch them retire, and just really have them focus on the things that are important to us for them, which is getting the most out of retirement in life.
Welcome back to Retire Well TV. My name is Cynthia DeFazio, joined today by Pete Samanuk of Citizen Advisory Group, and we're talking all about RMDs. You don't want to get these wrong. This is not something that you want to try to do at home. Pete, I am so glad that we're talking about this today, because obviously it's so confusing. We have a lot of people in the audience who are kind of DIYers, but when it comes to RMDs, it's very confusing. For instance, the calculations, that's so hard to understand. Can you give us a quick synopsis of how those are even formulated?
Yeah, so we talked about how you're required to take it at a certain age, depending on what year you were born. That could be 73 or 75. And that is based on the balance of that account the prior year as of December 31st. Okay, so I would say that if your required minimum distribution, I have trouble saying that word too.
See, I started
it's a real
it.
tongue twister.
It's my fault.
It's so confusing. They've made it hard to say. So that is going to be based on the balance of that IRA or 401k from December 31st of 2024 or the prior year. Okay. And then that's going to be age-based. The amount that you have to take, it goes up every single year. Right? So the amount that you have to take is going to be percentage-based. It's going to be a percentage of your account balance the prior year, and it's going to go up every single year the older that we get.
Okay. Gosh, so much to understand. It's so confusing. So with that being said, what are some of the traps that people are falling into? I know there's 6 that we're going to uncover right now, but the most common one, what would you think that would be, Pete?
Yeah,
you know this.
We'll kind of start with I won't call it a trap so much as again, a misinterpretation of the law, is that the IRS, if you read it, well, good luck reading about your required minimum distribution. Go read the tax code on it and tell me how to figure that out, right? But is that you are actually allowed to take your first required minimum distribution so most required minimums are due December 31st of the tax year you're required to take it.
Okay.
But the first year you have to take it, they actually allow you to defer that until April 1st of the following year. Okay, so they might say, hey, Cynthia, you have to take $50,000 out of that IRA before December 31st. But because it's your first year, they're actually going to allow you to wait until April 1st of the following year.
Okay.
So a big trap there would be that people are like, oh, cool, I can push it off, I can wait. But guess what? You're actually forced to then take 2 required minimum distributions that year. So you might have to take $50,000 by April 1st, and then another $50,000 or $55,000 or $60,000 by December 31st of that year.
Oh, wow.
And so you're doubling up, okay? So that's why we would call that a trap.
Yes.
Is that now you're doubling up, that's gonna bump you into higher tax brackets, you're gonna pay more tax on your Social Security, you're gonna pay more Medicare premium.
Oh
and
my
so
gosh.
that's one of the traps, is because they allow you to do that, and then you have to double up for year 1.
Yeah, so it's a gift and yet it's not.
Correct. Yeah. And that's the big thing I'm going
Right?
to talk about too, is that all of these
my
things,
gosh.
the age being pushed back to 75, them letting you do it by April 1st of the following year, they seem like gifts, but really they're kind of traps. I feel like
Yes.
they're traps. Whether they're laid intentionally or not is up for debate, but they are more traps than gifts.
All
I
right.
mean, it's
That
great that you
sounds a
said that.
little sneaky if you ask me.
Something
Okay.
like that.
So what about people that are still working? What about the failure to adjust the RMDs? Is that something that people do often, Pete?
Yeah, so another big thing where these are so confusing and there's so many caveats. That's why I love this topic and this show because it's a lot going
Yeah,
on.
yeah.
And it seems like such a simple concept, but the more you dig into it, it's not. I learn things every single month on required minimum distributions or a new rule or a new interpretation. So when you're still working, let's say I'm 73 and I have a 401k. And we do run into clients that are still working past 73, and you've got, let's just say, $1 million or $500,000 in your 401k. You actually are not required to take a minimum distribution from that account, even though it's pre-tax and even though you're over the required minimum distribution age, because you're still working. Okay, so I would also, again, call that a trap because while it seems like a gift, it's actually a trap. It's just kicking that can down the road and making your future required minimum distributions larger and larger and larger.
Okay.
So again, a thing we would call a trap.
Interesting. Absolutely. All right, here we go. This is going to go back again, but what about failure to use the account value as of the prior December 31st in the calculation? That sounds confusing as well.
Yeah, so I think there's just a lot of confusion around how much do we have to take.
Yes.
And a lot of times companies will let you know the amount you have to take, but you have to ask the right questions, right? You have to know the questions that you're supposed to ask them to get the right figure at the end. So a lot of times people will just take an amount out and say, hey, I did the calculation based on my balance today, but they might be shorting themselves. So they might be short $10,000 because the account has grown so much throughout that year. And we do have people run into that, but it was supposed to be based on the balance from December 31st of the prior year. And you might be paying a $2,000 or $3,000 penalty just because you misinterpreted what the law was supposed to say.
Oh my gosh, it's so confusing. And then here's people that have multiple RMD accounts, Pete. What in the world? You can't do that willy-nilly,
No,
right?
right.
So
this
talk
is a
about
good
plan.
one. Yeah, this is a good one. And we run into this and we talk about this a lot on this show is the junk drawer approach, is where we have accounts and things all over the place. So we might have 401ks from our current employer. We might have a 401k from 3 prior employers, all scattered all over the place. We have a pension plan. We've got IRAs here. We've got the IRAs all over the place. So you have to make sure that you're taking required minimum distributions from all of those sources, okay? And there's a I'm not going to get too much into this, but there's a concept known as aggregation. So you can aggregate certain accounts. You know, you might have 10 IRAs and the IRS says you have to take this amount out. Well, you can take that all from one account, okay? But the tax trap in all of that, or the trap that we're talking about, is that you cannot aggregate your retirement plans, your 401ks, your 403bs. So my big takeaway on this would be, don't try this at home if that's what we're talking about, is if you have any old retirement accounts, 403bs, 401ks, you might have lost track of them. You don't even know where they're at, what's going on with them. If you have any old retirement accounts, you've got to be aware of that. You've got to call us and kind of figure out, or at least talk to some planner or advisor to figure out, am I doing this correctly?
All right, I know we're going to take a commercial break, but this next one, holy moly, Pete, I don't even know how to do this. Failure to calculate your life expectancy annually. I mean, what are we talking about here? We have to get an actuary involved.
Yeah,
this is so confusing.
Yeah, kind of, right? So people, I mean, it's like they would, for the DIYers or the people that don't try this at home, because you only get one chance to do this right. You know, you're only going to take your required minimum distribution. You have to take it annually, but it's going to be the first time you've ever done it. You know, we've helped clients do this tens of thousands of times as far as taking required minimum distributions. So you might say, well, they made me take 3.9% out of my 401k last year based on the prior year on balance. That percentage is not the same. Okay, so that percentage is actually going to increase every year. And this next year, it might be 4.1%. We can't take the same percentage that we took year over year because it does increase as we get older.
Okay, all right, Pete. All of this is so confusing. To our viewers at home, we're going to try to end the confusion today. We have a very special offer for you. Call the number on your screen, 866-630-1675, or grab your smartphone and click on the QR code at the bottom corner of your screen. That takes you right to the landing page of Citizen Advisory Group. And why are you visiting that website? You're going to schedule your complimentary consultation with Pete and the team. Let them get to know you one-on-one. What are your goals? What are your dreams? And what are your hopes for retirement? And most importantly, what is your plan to get there? What is the purpose for your money? Because again, purpose determines placement. Don't miss the opportunity to book that complimentary consultation today. Once again, 866-630-1675, or click the QR code at the bottom corner of your screen. With that consultation, you will have a complimentary written income plan, the most important piece of your retirement plan. Once again, 866-630-1675. We'll be right back momentarily on Retire Well TV.
My favorite clients to work with are people that are really just down to earth and fit well into our family brand. So they're very nice people, they're very hardworking people, they're people that put a lot of value on family and friendships and socialization. There are a lot of firms, I feel like you're a number on a page, but I can tell you at our firm what truly makes us special, and this is a shout out to our founders and the principals of our business, Jeff and Kevin Bucher, is that they have built their business on taking care of people and really building solid family relationships, and that's kind of helped us with the success that we have. We have structured our team at Citizen Advisory Group so that the main thing that's paramount and important to us is taking care of clients. We have a full team of people that's ready to serve and take care of our clients, because that's really what we built our practice on. It's great to be able to go and talk to my team members and have a meeting with 5 or 6 other advisors to say, hey, this is the situation, what are we going to do about it?
Welcome back to Retire Well TV. My name is Cynthia DeFazio, joined today by Pete Samanuk of Citizen Advisory Group. And we're talking all about the importance of understanding your RMDs and mistakes that you do not want to make. That's why you need guidance when it comes to required minimum distributions. Pete, I know it's amazing for you to talk about this topic because you're so passionate about it and you're so knowledgeable. You're lit up right now. I love it. So one thing we should talk about, obviously, there's a lot of inherited IRAs. What happens with RMDs from inherited IRAs? How can you manage that properly?
Yeah, this is a big one I wanted to make sure we circled back on, because I'm talking about required minimum distributions on accounts that you own, that you've saved into. The tax code gets much more complicated and the laws have become much more confusing surrounding IRAs or pre-tax accounts that you have inherited. Okay, that would be my parents had an IRA, or I have a client, his brother had a big 401k, or my friend had an IRA that I inherited. I don't have any friends that good yet that are gonna, I don't think I'm the beneficiary in any friends' accounts.
You never know.
They might not even have accounts,
it could
I
happen,
don't know, right? Yeah. So that you inherited the money and you have a completely different required minimum distribution schedule than you do for your own account. Those have to be held separately. The new law is that prior, to 2020, I want to say, is that you could take those accounts out over the course of your life. You are now required to empty those accounts if that person passed after 2020 and you inherited that by the end of the 10th year.
Wow.
Okay, so not only are you actually potentially required to take money every single year out of it, but you're required to have all of the money out of that account by the end of the 10th year.
Wow.
And so what most people are going to do, and I'll call this a trap, okay, we were talking about traps, is why this is a trap is that what the IRS probably is going to run into a lot of times is that people aren't taking any money out of this account because they're not required to until the end of that 10th year. And so they're going to kick that can down the road. They're saying, hey, I don't have to take it. I don't have to take it. Well, if you're making, let's say you inherited an IRA and it was worth $500,000.
Okay.
And you made 7% per year on that IRA or that inherited account, it's going to double, roughly double in about 10 years, okay? 7% a year, $500,000 over 10 years is going to turn into $1 million. So now guess what has to happen at the end of that 10th year? You have to take $1 million out of that account and pay all of the taxes on it. Now, what do you think that's going to do to your taxes, your Medicare, all of those different types of things? It's going to add $1 million. And guess what? You're forced to do it. They are going to make you do that. So inherited IRAs, it's very important that if you have those, if you've inherited something from a friend, a family member, most likely a parent, that you understand the rules and what you're going to do. And again, good luck reading the IRS code
Yes.
or trying to give them a call and have
Oh,
them answer that question for you.
it's so complicated. So, Pete, obviously, a lot of your viewers and a lot of your clients, they don't need the money that is the RMD distribution, if you will. What are some options? What can you do with it if you don't need it?
Yeah, and this is going to go back to partially our philosophy at Citizen Advisory Group as planners, is that you're maximizing your goals and what you're trying to do. You know, my first thing, I'll have clients like, what should I do with this required minimum distribution? I mean, my first thing is like, go spend it. You know,
Yeah, go have fun.
let's go find something to do. Let's
Absolutely.
book a first class flight. You know, take a trip with the family. But you know, the reality is that everyone's just different, and maybe we just don't have a need for it. And a lot of advisors, what do they want you to do? You know, their first answer or their plan for you is to reinvest it.
Sure.
Why do they want you to reinvest it? Well, because now the money stays in their pocket. It's under their umbrella. They continue to get paid on it. So you can do that. You can reinvest the money. There's different strategies you have to be aware of, like the qualified charitable distribution. So that would be called the QCD,
Okay.
qualified charitable distribution. If you're 70 and a half, you can take money directly out of your IRA or your 401k to a qualified charity, and you don't pay the taxes on it at all. Okay. So if you're charitably inclined and you're not aware of that, or if really you're giving any money to your church, which is common for a lot of our clients, or just, you know, any charities in general around the holiday time, if you're over 70 and a half, I would argue pretty much all of those charitable donations should be coming directly out of your IRA, because it's saving people thousands. I have clients that save tens of thousands of dollars by utilizing that strategy.
Sure, it makes sense. And again, it has to go directly to the charity. It can't go into your account
Correct.
and then the
Correct.
charity.
So,
So
yeah.
that's,
The big difference is clients are taking the money out of the account,
yeah.
right? I take $10,000 to myself, pay the taxes, and then give $5,000 to a charity.
Yeah,
You have no tax, there's no benefit for doing that.
exactly.
Instead, you might take $5,000 to yourself and $5,000 over to the charity and save 22% tax on that,
Yeah,
right? We've just
yeah.
saved you $2,200 in taxes just based on that rule alone.
Absolutely. Well, Pete, thank you for another amazing episode
Anytime.
this week. To the viewers at home, thank you for spending time with us on Retire Well TV. To book that complimentary consultation where you will receive the complimentary retirement income plan, the number to call is 866-630-1675, or even simpler, to get on the fast track of Citizen Advisory Group schedule, you can click the QR code at the bottom corner of your screen. Schedule your time accordingly. As you can see, retirement planning is more than one piece. It's a puzzle that needs to fit together cohesively. Take advantage of the offer today. Be safe, be happy, and be blessed. We'll see you soon. Take care.